Hey, happy Monday, everybody. It's June 22nd, 2026. I, of course, am Hammer, founder of Hammer Solutions, home of great products that help my originator friends get more business in 2026. Products like Originator Success, Grab and Go Social, and Rate Sensei. So remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasting on Facebook and YouTube. If you're here this morning, say good morning in the comments. Love to hear from you. If you're watching on the replay, don't forget, please go ahead and give me hashtag replay in the comments. Let me know that you were here. Fast forward to the part where it says, let's get started, and you can skip all the other stuff. But if you would like to start joining me live, or if you're here this morning and you want to make sure you don't miss a moment of the live show next time, make sure you sign up for our text reminder at hmmr.io/reminder. I send out a text alert as I'm going live with the links, so you don't have to depend on social media to remind you and you don't miss a moment of the show. You could also use this cool QR code over here. If you're on your phone right now, take a screenshot, go back, press and hold it. It should open that link, and that's how that works. Also, you can sign up for our free daily lock advice email that goes out each and every weekday. You can go ahead and sign up for that at ratelockadvice.com. You can also sign up for our text alerts at ratetextalerts.com. So hope that helps as well. All right, my friends. Well, let's go ahead and jump into some of the other stuff. Let's go ahead and say hi to all the live folks. We got Jerry Simmons, Angela Walters. Good morning. Sean Segaloff, Megan Bissell, Holly Johnson. Great to have all of you here. Sean, appreciate you always sharing our crowing about us and sharing us on social media. Always appreciate that, man. And the fact that you are a friend and a supporter means a lot to me. So Mallory Fotiatis, congratulations on the new digs, and hope that it is everything you want it to be. I remember changing companies and kind of reinvigorates you, but it doesn't always work out the way that you think it will. At least it didn't for me. So good morning, Bobby J. Jones. Great to see you here as well. All right, let's go ahead and get started. We'll jump in. Let's start with the technicals this morning and kind of see where we're at. You guys know the routine. Starting off with the technicals, let me pull up Presentify real quick, and we will. There we go. All right. So taking a look this morning, it is unfortunately not green, not what we want to see. Mortgage-backed securities currently down 13 basis points, measuring that 5.5 coupon. Remember, you can watch the 5.5, the 5.0. The 5.0 is down 20. You'll notice that the 6 will be down less, right? So that's also 13. So, but the 5.5 is what I think is the one most accurate to be watching right now. The one that most traders are watching as well. So anyway, 10-year treasury, look at that 4.49. After flirting and being down to that 4.43 area that it was over here, it's pushing back up, testing that 4.5. So it's up to 4.49 this morning. None of this is really what we want to see, unfortunately. So quick recap, markets were closed on Friday for Juneteenth. So if we take a look at what happened on Thursday here, you can see that on Thursday, that's everything in front of this dotted line right here. We could see that when pricing came out, we were kind of at the good part of the day right here around 10 a.m. and that we did lose a little bit of ground. Bonds did drift a little bit lower as the afternoon went on. Wasn't enough for most lenders to reprice worse, but there were a few late day reprices worse as lenders kind of protected themselves over the long weekend. But overall, not too many changes between when pricing came out. But you could see where we're at this morning, much, much lower than where we were at on Thursday up here. So when you see this much of a drop down, what that means is that when we take a look at rate sheets are going to be worse. If we take a look and see where we were at again on Thursday, which was the 18th, you could see that we were at 6.58. So this morning, we're probably pushing back up to 6.6 or maybe even 6.62. So kind of giving up some of those gains that we saw here. So, but the 6.62, that was, if you remember, that was on Wednesday after the Fed meeting. So kind of where we're at. But bonds are down despite positive headlines and declining oil. You know, we've got positive headlines. Iran cites major progress after all-night talks with the U.S. Yes, I owe. Who was it that told me last week on Thursday that we had signed the agreement and so had Iran? And I said Iran hadn't signed, but I was wrong. So the agreement with Iran was signed early. So although there was no Friday negotiations, everybody had pre-signed it on Thursday. So again, I was away in New Jersey, so I missed that headline, unfortunately. Sorry about that. But overall, what's funny is this is basically just another extension of the ceasefire. It's not a real agreement. But what it does do, which really helps with oil pricing, is it opens up the Strait of Hormuz. Now, oil prices have dropped down. Despite oil prices dropping down, though, you notice that bonds are still higher this morning. Brent crude, $78.29. Look at this for the last 6 months. Look at how low that is right here. And yet this morning bonds are worse, right? So just we look at the 10th, the 11th, the 12th, where oil prices were. It was about $12, $13 higher than where it's at today. Continues to hold steady, in kind of the $80 range for Brent crude. When you look at WTI, that's down around $75 a barrel. So, but none of this really helping bonds. How bonds are not getting a boost from this at all. So if we recap kind of what happened last week. Oh, by the way, repressures today is low. I wouldn't worry about us getting too much worse than what we're seeing right now, down about 14 basis points at the moment. Not likely to see much of a sell-off from here, but that is kind of, the lower end. Also, we are going to continue to watch this 10-year Treasury yield at 4.49, hoping it doesn't go back up. Remember, it did push up to 5.57 here. That was back on June 8th, but it's obviously much lower than that now, but still not where we want it to be. Hopefully it does work its way and drop back down is what we want to see on that. So good morning, Mike Morano. I did have a nice Father's Day. Thank you. What's funny is on Father's Day, I did not see either one of my kids. I'm not big on Father's Day. I'll admit it. I'm not big on any of the kind of prefab holidays. So, but I don't want to take anything away from those that do celebrate them and, that it honors them and everything else. So happy Father's Day to all the fathers out there. Hope you did have a good one, but mine was good, even though I didn't see my kids, but I just spent days with them while I was in Jersey. So anyway, taking a look here, the Fed outlook is really kind of playing a role in this. And that's what we're seeing as one of the reasons why we're not likely to see rates improve much from here anytime soon, unfortunately. The idea was the Strait of Hormuz was going to open. We were expecting to see a much stronger reaction in markets, to see much more of a celebration, just not getting it. Really not getting it. You're not seeing it on the 10-year. You're not seeing it with mortgage-backed securities over here. It's just not, it's just, I thought when I did this, it made it. I don't know. Anyway, we're just not. It's not there. No improvement, and a lot of that is because of the Fed meeting last week. Remember this red candlestick here? The Fed meeting was much more hawkish, and more importantly, the press conference with Warsh. The dot plot had 9 members that felt we would see at least one rate hike this year, one Fed rate hike. Again, cuts off the table. We are totally talking about hikes at this point. And when you take a look here, for the first time since before the meeting, if we take a look at compare, a month ago, a week ago, there was no expectation of a Fed rate hike in July. And yet once we had that meeting, boom, now there's expectations of a Fed rate hike. And they really, really jumped. So expectations, it's 2-1 that we'll see things hold the same, but there's 6 weeks in front of us where we could see continued increases to expectation that we're going to see a rate hike in that July meeting. By the time we get to September, it's more than 75% of an expectation that we're going to have a rate hike. So markets are already pricing in rate hikes because inflation continues to be a problem. The Strait of Hormuz being open, oil prices coming down, not enough to curb inflation quickly or to bring it down quickly. Markets are betting the Fed is going to get involved. Remember, last week, Kevin Warsh said that inflation was the biggest focus of the Fed, didn't even reference the second mandate of employment. So that's why we're not likely, bottom line, we're not likely to see rates move much lower, even though we've got these positive headlines about what was happening in Iran. This was the major mover since the end of February, or we'll call it beginning of March, April, May. That was the main driver for rates and pricing, was what was going on in the Middle East and with Iran. Now that's going to take more of a backseat. We're going to see more of a focus again back on the Fed. We've got, a while before we get jobs data, but even that jobs data not likely to change the mind of traders that the Fed is going to hike rates, because Warsh didn't even bring it up. They're not worried about the labor market. They're worried about inflation. And, it's, I don't know if he got a hall pass from Trump or what, but, it's funny because if this had happened under Powell's watch, people would be screaming about how terrible Powell is. And yet, they recognize that we have to fight what's going on with inflation. And the Fed has kind of signaled that, and that they're not really willing to make a move. So that's what we got going on. As far as lock advice, I would very, very much consider locking anything closing in the next 15 days or so. These aren't great rates and pricing, but when we look at where we're at with rates and pricing, we're very much in that same range, 6.58, 6.56, 6.60. We may see some improvement to get back down to 6.54. Overall, this is all just differences in rate sheet pricing. You're not really going to see this change interest rates offered, but what it costs or how much credit somebody gets to get that rate is kind of what we're seeing. I think we could easily end up back up where we are looking here at 6.68, basically even 6.75. We can see rates move higher from here. Despite the Strait of Hormuz opening, despite oil prices getting better, it just did not give us the boost that we were looking for improvement. It was, expectations were that once we would see the Strait of Hormuz open, even though they're saying that it'll take months to ramp up the amount of ships moving. I mean, let's face it, ships are moving through there a lot more than they were when there were none, or just a few sneaking out, right? So, but we're not seeing the improvement, and a lot of that has to do with inflation and the Fed and Fed rate hikes. And that's what's going to lead. This is going to be the new leader. As far as anything 15 to 30 days, cautiously float, but don't be afraid. Don't hesitate to lock risk averse or those not wanting to gamble. So it's not even willing to gamble, but it's wanting to gamble. So for anything that's 15 to 30 days out, cautiously float, but don't hesitate to lock anything that is, the reality is that we're not likely to see rates move too much higher from here. We're probably trapped in a range. And over the next 15 to 30 days, we're not likely to see rates move much higher unless we get a really hot labor market report, or the inflation reading a month from now, just under a month from now, comes in really, really high. So we'll see, but don't be hesitate to do that. And anything that's 30 days out, you can still float though, because we're not really worried about where rates are going to be. But there's not a lot of risk that they're going to be a lot higher than where we're at right now, or that we won't see a window where they come back down. So keep that in mind. Hope that helps y'all today, guys. I'm going to go ahead and wrap it up. Thanks again for watching. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. Glad to have you on here. If you would like a reminder that I'm going live so you don't miss a moment of the show, if you join a little late, make sure you sign up for our text reminders at hmmr.io/reminder. You can also sign up for our free daily lock advice at www.ratelockadvice.com. Get an email to your inbox each and every weekday morning. Don't forget our text alerts at ratetextalerts.com. They're $7 a month. You protect your pipeline and, be alerted. So there you go. All right, my friends, I'm going to wrap it up. Thanks again for joining me. I'll see you guys tomorrow. Take care, everybody. Make it a great one. Bye-bye.